Welcome back to the Alts Podcast. I'm your host, Horatio Ruiz. We bring you industry leaders and creators to give their insights on the rapidly changing and exciting world of alternative assets. Opinions expressed on this podcast by the host and podcast guests are for informational purposes only and should not be considered investment advice. Podcast hosts and guests may maintain positions in the offerings discussed in this podcast. Today's guest is Anthony Morena, the principal at Mortar Group. For more than 20 years, Anthony and his team have focused on real estate in niche New York City neighborhoods, and in the process, gaining a competitive advantage among New York real estate boutiques. Mortar Group has developed real estate in some of the most desirable and up-and-coming neighborhoods in New York, including Williamsburg and Astoria. In this episode, Anthony talks about Mortar Group's unique approach to real estate and architecture, the New York City real estate market, and how being a small boutique firm translates to added value for investors. I hope you enjoyed my conversation with Anthony. All right, guys, thank you for joining the podcast. We have another great real estate company. This one is focusing on New York City, really doing some unique things, targeting certain neighborhoods in New York City. We have Anthony Morena, the principal at Mortar Group. Anthony, thank you for joining the podcast.
No, thank you for having me. I appreciate it.
Yeah. So when Mortar Group came into our, sight lines, I guess you could say, the first thing that caught my attention was how you guys are investing in niche neighborhoods in New York City. Mm-hmm. And I found that so cool because really it's like you guys know what your market is and you kind of are executing on that. And so that's something that we're definitely going to delve into. At first, though, I wanted to maybe give you the chance to introduce yourself,
Sure.
Your history at Mortar Group and how you became the principal at the firm.
Sure. No, thank you. I appreciate it. So just, like you're saying, some background about us, or, I'll start with myself. I've been doing real estate in New York for about 20 years, going on 21 years. I started off in the field on the architecture side of the business, graduated from architecture school. I'm a licensed architect in New York. And early in my career, I kind of set the idea that I wanted to create a firm that would take my background of architecture, but integrate real estate development, which was another thing I was doing at the time. And it kind of merged into this group where we can vertically integrate and be efficient with construction, architecture, and development. That's how it started. And it kind of went from there to like a friends and family type of business where we did a few deals like early 2002, 2003 with friends and family. And then it kind of expanded from there and kind of, has grown to what it is today. Mortar Group, over the years has evolved a bit. We're, like you were saying, we're a New York-based firm. We do all of our work is in New York. We kind of stick to what we know. I think we're a mid-cap real estate firm. We're just below. We operate just below like the larger institutional funds or pension investments. We stick with multifamily, residential, I would say 95% of the time. We do some office and some retail, but it's mostly residential just because that's our specialty. We know how to be really efficient and move it and do it well. Like I was saying, we've been doing it for about 20 years. At this point, we've done just over probably 30 offerings, different projects. So we've been pretty active over the years. And we do work in Manhattan, Brooklyn, and Queens predominantly. We do some stuff outside, but for the most part, that's kind of our spot. And, we do a mix of ground up construction work and your more traditional value add investments. So I would say it's about 50-50, 60-40, depending on the where we are in the cycle, each year. And that's kind of what we do.
Interesting. When you say ground up, because in my research, I saw you guys do a lot of value, adding value to current mm-hmm. buildings. Ground up, do you mean like basically demolishing maybe an existing building and then building up from there?
Yeah. So a lot of times what we'll do is we'll find a site, or we'll pull together a few different sites, demolish existing assets that are there, or if it's a vacant lot, and we'll build. Traditionally, our kind of wheelhouse is usually, I would say, 10 to 30 units is kind of our specialty. We're kind of in that $10 to $40 million range on a deal size. And that's kind of our niche that we've kind of worked in. But yeah, it's a mix of, your ground up construction starting from just a vacant lot, designing it in-house, building it in-house, and then bringing it to market and with a disposition and a sale, or your more traditional kind of value add where we'll buy existing assets, existing multifamily, and go through, I would say, a 3 to 4 year process of renovating, rehabbing, improving, and just increasing revenue over the life of the deal with the sale at the exit. So it's we kind of do a little bit of both. For us internally, it's nice to do both. Construction takes usually about 2 to 3 years to do. Renovations inside apartments takes a couple of months. So it's nice while you have construction going on to get some instant gratification from some renovations here and there. And, I think investors enjoy it as well.
Yeah. And I think, and as we go into some of the details in a little bit, I think that when I was doing research on the company, it's almost like a self-contained firm, right? And kind of like your motto was like invest, architecture, development.
Yeah.
And so basically you guys are in-house and you guys are, for the most part, right? Like you guys take care of everything pretty much. Is that?
Yeah, for the most part, we'll sub out some stuff, but the goal was, early on was like, we want to be a boutique firm. We're not competing with the big guys. We're a boutique shop. We like doing what we do. We can do it well, but how do we distinguish ourselves? So the idea was by combining and integrating some of the design, the construction, the development in-house, we found that we could be more efficient in some respects. We can boost investor returns in some areas, and we can be faster to bring a project from a vacant lot or from an empty building to completion and to sale. We'll still sub out some elements of construction and more on the marketing and the sales and the brokerage side, but as many of the pieces that are happening during a construction project or underwriting, we'll try to take it on. We're a small team. We're about 6 people right now, but I think we can be efficient, and we've got different parts of the team that can handle everything pretty well.
Awesome. I think one of those things that I noticed from the website was like you are able to establish like up and coming areas, and kind of maybe try to buy some properties there, and then you talk about investing in New York City. How do you traverse the New York City market, right? And I think like you have an advantage there where you're not looking at things nationally necessarily, right? Like you're looking at things more locally because you are a New York guy. But even then, like, what are the challenges of identifying, or maybe it's not so much a challenge, maybe it's an advantage of identifying specific up and coming neighborhoods in the city?
Sure. No, it's a good question. It's something, that comes up often. I think, I grew up in New York. So being with that, you kind of get a natural sense of the area and the land. And after doing it for 20 years, we stick with certain neighborhoods, certain areas, certain parts of the city that we feel can deliver the largest ROI for investors, and where we can still be efficient in what we do. But after doing it for a while in certain neighborhoods, you start to get a sense of what pricing is. So we know, when you're looking at new deals right away, we can kind of tell what the value is at the end. The back of the envelope or the napkin review is pretty quick, and we can kind of see what deals make sense. So we tend to look at a lot of them, and we can really kind of parse what makes sense, what doesn't. And then if there is something that makes sense, we can move quickly. And that's kind of one of the advantages that we have. And I think that it's served us well in the past. The other thing I think is, as we do construction in different parts of the city, you start to have a network of brokers or, even sellers that are looking, or owners that are looking to sell different buildings. So you're always hearing about things probably before they go to market. So you get an opportunity to see, catch deals off market right before they go. So, we can analyze those quickly, be efficient, and then, that's, the early underwriting part. And then it's when you're in the analysis of, the sale at the end, we know we have a good sense of certain markets and, what they're looking for, what their needs are, what the comps are, what the inventory is, or what is coming on. So, I think between those two elements, we can really kind of, take advantage of our being locally based and, and do well. We've looked at in the past at kind of looking outside of the city or outside of, the Northeast for the most part. And I always had trouble with the idea of, looking at a place in Miami on Google Earth and trying to get a sense of where that was and what was going on. There's too many kind of items you can miss in that sort of due diligence where you're not really an expert in your location. So for us, it ended up that Manhattan, Brooklyn, Queens, we can look at any deal. We know pretty much what the numbers are right off the bat. We'll always verify them, but it gives us a leg up, I think, to kind of really kind of dive into to projects and do well that way.
What is unique about the city? Like, what are some of the characteristics that make neighborhoods appealing? Is it like access to mass transit?
Mm-hmm.
Is it parks, even access to parks, things like that? What are some things that kind of stand out to you as you're looking at the land?
Well, it depends. The other interesting thing about it is like when you look at different neighborhoods, each neighborhood, and there's so many people. There's millions of people in New York City, and each neighborhood has its own demographic, its own culture, its own life, and its own heartbeat to a certain extent. So when you're looking at different projects in different neighborhoods, you can really kind of see what some neighborhoods are school based. People are going to those neighborhoods. They're large. They're more for established families. They're looking for good public schools. There's others that are kind of people looking for that are younger in their 20s, just out of college. They're looking for more of an active scene. And transportation, and access to Manhattan and getting to work. That's changed a little bit now with after COVID, where people are looking for more amenities in their buildings, which we've all kind of adapted to over the last couple of years. But yeah, I think each neighborhood kind of brings its own dynamic, and some of the fun part is kind of see where we can make things we can offer a little bit more for residents coming in because we understand their market. Like if you're looking at, like we have two projects under construction that are similar, but they're very different in their neighborhoods. One is Prospect Heights in Brooklyn, which is a neighborhood for families. It's larger apartments. Transportation is important, and it's an established community. Williamsburg or Greenpoint is a completely different dynamic. It's a younger group. It's a hipper group, and it's more about just the general nightlife activity and everything that's growing around that neighborhood. So it's doing work in both neighborhoods. You're designing and you're marketing. You're designing buildings completely different. But that's part of the fun part. And I think after you work here long enough, you can see what you can do in each area to make a deal work. Sometimes you can find hidden gems that could really kind of help boost returns on the investor side. They could be little details that just being local sometimes can, you can help identify.
That's really interesting. Like it's almost, it seems like, you have this model that's been working for you for years, for 2 decades now, and you kind of follow it, but within that model, you're being flexible, right? Adapting to the neighborhoods, adapting to the people that are going to be renting out the places, buying the places.
Sure.
So you are primarily in multifamily or, different room buildings. What else goes into the investment? Like when you talk about adding value, like what are some of the things that might add value, say when we're talking specifically to the building, right?
Mm-hmm.
For a family, or for somebody that's maybe starting out their professional career. What are the things that are bringing those returns to the investors?
Well, I think it's a combination of things. I think the first part is when you're buying an asset, if you can identify what you think how you can really help an asset to work well on the exit, you can really buy well, you buy efficiently. I think that's the key. It's like if you win or lose sometimes just by how you bought something. Because it takes a while to really go through the process with renovations or construction or taking an existing asset and creating it into what you want. But I think, when you're going through the process, you can try to, you look at different markets and kind of see, what's the inventory like in certain neighborhoods? What's the price point? Some neighborhoods have a higher price point than others, but we can get more creative in different markets and kind of, add different amenities to buildings where it will help us to rent or stabilize a building faster or bring it to market faster and sell it quicker. Sometimes because we're doing a lot of the stuff in-house, we'll be able to, basically pre-lease a lot of our work or our projects or pre-sell, before we're completed. So doing that allows us to exit as soon as construction is done. We exit, there's a sale, and investors get their money back earlier. And it also helps their IRR and their ultimate return because just the time that it takes to finish a project has been compressed. Mm-hmm. Like for us, usually a construction project or a ground up construction deal from the day investors kind of come in to fund and say they're interested and then they fund, it's usually about 30 months till they get their money back and then they get their return. So it's a really compressed schedule where we'll sign a contract to buy an asset, and we'll work in-house basically for 6 months on design, construction, getting everything ready to go before we close. And then right before we close on the acquisition, we'll request, funding from investors. And so basically, we've been working on a project for 6 months in-house, and if the deal closes, that's just, that's great, and we move along. If it doesn't close, we eat the cost. That's just the kind of the price of how we do business, because the benefit is that starting, closing on an acquisition where you have all your ducks in a row, and being able to basically start work and construction the day after you close on a loan or an acquisition really kind of shortens the amount of time that investors' money is put to work or at risk. So, I think ultimately, it allows us to finish deals in about 30 months, which, I think investors tend to like. It fluctuates. Sometimes you could be a little bit faster, a little bit slower, but overall, when we kind of look at all of our deals and all the projects we've done, it always ends up being around 30 months or so.
There's a lot I want to get into, but that strategy where you're putting 6 months of work without really knowing if you're going to get the close, I think you got to be confident in your work, because if you're putting all that work in 9 times out of 10 or whatever, I don't know what the numbers are, but the majority of the time you better be closing, right?
No, it's a risk that you take. For the most part, I think we've been fortunate in the fact that once we find an asset that makes sense, and before we dive into it, we'll do kind of our own due diligence to make sure it's something that can work. But yeah, it's a risk you take. But I think it's one of those gambles where I think we've become pretty efficient at it. So we know if something makes sense or not pretty early on. And, I think it helps with investors because aside from putting, because usually with the sponsor, we co-invest with the investors. We provide the guarantee for the debt for the project. But investors knowing that we have put a lot of time in early on and we've spent money in that respect, it's a different way of kind of showing that we're tied to the work that we do and to protecting capital and protecting the investors along the way.
All right. I was also kind of curious about the percentage of your investors that are New York City investors. Like, do you have investors from all over the country, or do you have investors specifically, lined up, from the city or just from all over the world?
Yeah. So it started off where it was a lot of local investors. The first 10 years of in the business was mostly local. And then, as word of mouth kind of started to spread, it started to get on a more national level. And then I think over the last 5 years, with kind of the advent of or being able to access deals online or through different investment portals, stuff like that, for the most part now it's a national group. There's people from all over. We still have a great number from New York or the Northeast, but it's Midwest, it's the South, it's California. People are coming from everywhere. And it's interesting because a lot of those investors that are coming from outside of New York, they're looking at us because they have exposure or they have investments in their markets, So they're like, okay, you know what? I have an investment in Texas, but I want some diversity. So they're trying to diversify their portfolio by looking at stuff in the New York or in the Northeast. So we've met a lot of people along that way. So that's been pretty interesting. But yeah, it's become. And we have international as well, so it's kind of become this broad group. So it's been interesting, and you meet a lot of interesting people along the way. Each kind of, because we deal with individual investors, high net worth investors. You're dealing with people, so you're speaking to everyone. You're getting a sense of what everyone's kind of looking for. You're getting a taste of what investment people are interested in, and also their strategies. Everyone's kind of got a different strategy on how they want to make their money. Are they looking for passive income? Are they working towards retirement? Are they trying to retire early by hitting certain milestones? So everyone's kind of got their own thing that there's a tax benefit that they're looking for. So it's always these different groups. So it's a broad group from around, and everyone's got their own story, which is I think is pretty interesting.
Yeah, for sure. Real estate's never ceases, right, to amaze. Let's talk about that a little bit then. Let's get into like the investment deals. You mentioned high net worth investors. I know you guys are looking for accredited investors, but I kind of want to, if you can speak to in terms of minimum investments, if there is a minimum at all, in terms of like, or if it varies from project to project, and kind of highlight your returns and who typically who are your investors, basically.
Sure. Yeah, no, traditionally on our projects or on our offerings, it's about a $25,000 to $50,000 minimum per investor. And like I was saying, people are from all over the country, and each kind of has their own strategy on how to invest or what they're looking for. So for us, it's, I think, offering kind of a mix of ground up construction that has a different return profile than your value add, which is a safer, more conservative, but also does well on the return side as well. But they're different animals, so I think you try to show investors different options in what you do. But traditionally on the projects that we have, like our traditional value adds work, is you'll have a project that's after there's an acquisition, an investor kind of comes in, the assets are acquired, and then we'll do a quarterly distribution to investors over the life of the investment. And then at the end of the project, there'll be the sale, and then they'll get a preferred interest hurdle, and then there'll be a split between the investor and the sponsor. And in the meantime, we'll do, so like we have a project now that we're doing, or an offering now, where we're doing cost segregation in the first year. So we'll cost segregate, bonus depreciate the assets. So then what happens is on the investor tax returns, they'll get deductions that they'll use, and sometimes they'll use our investments to offset gains that they get on other deals. Like if someone does well on one project with another sponsor somewhere else, and we can offer them depreciation to help offset that gain. It kind of works out that way as well. But in one, like I was saying, the offer we have now, the investors are getting paid a 7% annual interest, preferred interest, as kind of their minimum, and then it's 75-25 split over the life of the project. And then at the exit, this one's a little bit longer. It's a 4 to 5 year to hold. It's about a 25% return on an annualized basis after the sale. So you get your quarterly distributions, you get your tax benefits, and at the end, you get a larger kind of payout. And I think that's kind of worked for investors well. Traditionally, to the other part of your question, on an annualized basis, if we kind of look at all of our deals since 2001, we kind of float in the high teens to low 20%. So I would say about 16, 17% to about 21, 20%, 22% annualized return on our projects. Some are higher, some are lower. I've been working in New York since 2001. When I started, there was September 11th, and that the effect that kind of had on the market. Then we had kind of Lehman crash in 08, 09, and then we had COVID. So we've seen the upsides and we've seen the downsides. So now it's just, when you average it all out, we try to be consistent.
Yeah. Your whole kind of analysis, I think was pretty interesting. You guys are working on multiple fronts there. Like, you're talking about even the benefits of tax break, tax benefits. You're talking about, quarterly dividends and then your final payout at the end. I mean, a lot of thought goes into that. And as an investor, I imagine that you want to see that net, by you doing those three things, that there's multiple ways to engage investors and what you mentioned before were their goals, whatever that is. So, kind of just curious, I mean, this is the New York City market. One thing that caught my attention was you have and I don't know if this is the project you were talking about, this project in Astoria, Queens. It seems like it's the biggest project you've had in terms of cost or value. And I'm wondering if you could highlight that. Like, what are the challenges? I think it was like maybe a $13 million investment, I believe.
So the largest deal we've done is a deal right off about a half a block from the river in Astoria, Halets Cove. It's in total, it's about a $32 million deal. The debt is around 14 million. And it's a 30 unit development, 32,000 square feet. And from a ground up construction perspective, that's kind of the largest that we've done to date. And that was a deal that we bought coming out of COVID with what became kind of a bit of the COVID discount that you were getting on assets that were kind of coming out. It was off market. We were able to buy air rights to help assemble the deal. So that's under construction now. And it's moving along well. You've got to navigate the hurdles as they're kind of thrown at you. With construction, you're going to always deal with construction hurdles. you've got to deal with the interest rate environment and how that's affecting things now. But I think overall, that project is under construction, will be done by the end of the year. But so far sales are strong, rentals are strong. Things are slowed a bit right now, but I think in general the market is there. Astoria is one of those neighborhoods that there's a low inventory, high growth. During COVID, there was a huge shift in population that kind of came to that area, that part of Queens. And it took prices up significantly, where a one bedroom would have been $1,800 to $2,000 is now $3,000, $3,200. So it really kind of pushed prices up. So I think we're in a position where we can kind of really take advantage of that. And the return model for this project it fits kind of the same kind of averages that we're kind of looking at historically. That's kind of usually our wheelhouse. That high teen, low 20s return on annualized basis for investors. Usually that's kind of our goal for any deal that we kind of really look at.
Yeah, I wanted to highlight too, because it is one of the available investments right now for investors. Curious, and this is kind of like a bigger picture question. I don't know if you have any ambitions or any kind of like model. Could you spread what you're doing in New York City in terms of like your analysis? And we've touched upon this a little bit, but into other cities, like how different is New York City, say, even from other Northeast cities, like say major cities like Boston or Philadelphia? Is this something that you can almost, replicate somewhere else?
Mm-hmm. Yeah, I think it's one of those things you can replicate it. You just want to take your time and do it efficiently. We won't really jump into a lot of deals, but there's certain markets that we've been looking at and studying for a while, for years at this point, just to kind of keep an eye on what's going on there, what neighborhoods are looking good, what deals are popping up, what stuff is coming up for sale. You just kind of keep an eye on it, so that in the event that we go to make a position or to make a shift or find a deal somewhere, we can be well educated in what we can do. And analyze it quickly, be efficient, and continue the same thing that we do in New York somewhere else. But we have, I would say, about 3 to 4 different markets that we kind of keep an eye on. And I think as this market the real estate market continues to evolve over the next year, with rates being where they are, I think there'll be some opportunities where we hope to kind of take advantage of.
Absolutely. Anthony, thank you so much, for being on the podcast. I kind of want to let you speak, if there's anything that I haven't mentioned or, haven't talked about Mortar Group that maybe you feel we should, to our listeners, please let me know, is there anything that maybe we can continue to mention or what is the next step for you guys as you're searching for more investors, as kind of a follow-up question?
Yeah, no, I appreciate it. No, I think, this was great. We kind of touched on a lot of different things. And, the goal for us is to, we're not looking to scale to be a giant firm. We're a boutique shop. I like being that way. I like dealing with the kind of deals that we look at. So we're not looking to expand in that size, but we're looking to kind of do more of what we do well. So it's kind of always try to expand in that respect. Like we were saying, we have the deal in Astoria that we're doing that's under construction now that we just kind of touched on. And then we have some value add stuff that we're doing now in Brooklyn and Queens that we're raising capital for. Same kind of thing where I think we were able to take advantage of some swings in the market over the last few months, and all that stuff. One of the best things I think that we've been able to do over the last couple of years is try to coming out of COVID. The biggest thing I learned was communication with investors and with your team. When people are reading things in the news and all hell's breaking loose all over the country, and people want to know, how is my investment? Is it safe? What are you guys up to? So we really tried to refine our communications with investors and to try to lay it all out there with, webinars, videos, progress reports, try to be as transparent with everything. And we set up our investor portal on our website where everyone can kind of access deals 24/7, see what we have new or kind of in the pipeline to see if they're interested, but also kind of check on the existing investments they have, gather all their financials, see what we're up to. And that's, I think, been something that we were working on before, but I think COVID really kind of magnified it and made it work a lot better just by going through the process. And I think just being available to investors is something we've focused more on. And, being a boutique shop, we found that one of the benefits was, I'm the principal, we're a small shop but when you deal sometimes with larger firms, people can get lost in the shuffle. When you deal with a smaller shop like us, it's either myself, our investment manager, or our marketing team that you'll be speaking with. If someone wants to reach out, and is curious or has a question, or investor is curious about how a deal is going, or they read something in the paper, they want to touch base. I think that's the nice thing that we're trying to really kind of lean into a bit and focus more on is being available and being transparent to investors that they're trusting us with their money. Individuals are very different than dealing with a corporation or an equity fund. People work hard for their money, and they're trying to put it to work wisely. So we try to take that with full seriousness and really try to work to earn their trust as we go. And that's kind of the goal. It's just as we go, just expand, do more of what we do, but be careful with the trust that's been given to us. So that's kind of the goal.
No, that's excellent. And me just always continuing to kind of peck. If you don't mind, one more question was, what was it about COVID that really you felt, and I know you mentioned you guys were working on the communication aspect before that, but what was it really about COVID that kind of, brought that to the front, right?
Well, no, it's a good question. And it's funny, as COVID starts to be in the rearview mirror, you start to forget very quickly, but it's at the time, if you look at, March of 2020, we had work we had active investments. We had construction projects under construction. We had things on the market, and the world essentially shut down for 6 months. And, a lot of, people are reading a lot of different things, what's going on in the markets, different parts of the country were reacting differently. Some markets were doing really well. Some were sort of slow. So the idea was just really kind of in two respects. One is with the investors and with our team to really communicate, make sure everyone understands what we're up to. Investments are safe. Here's what's going on in the New York market. Here's how we're adjusting. And to make deals still work for the active deals that we had. And then it's also kind of coming out of COVID. What have we learned? How can we be more efficient? What are, dealing in multifamily? What are residents looking for in a building today in 2022 or 2023 that they weren't looking for in 2018? What are the amenities? The amenities or things that people are looking for has changed drastically. So you just have to be up to date. You have to be kind of focused on your investor group, but also on your clientele on the residential side, the residents. What are they looking for? So you can adapt to that. So it's kind of the two-pronged approach to dealing with that, which I think we kind of learned through COVID, where just keep your eyes on what things that are going on and being able to adjust quickly. The nice thing, going back to the original idea about being vertically integrated, is when you've got the owner, the contractor, and the architect in the same office, you can have a 30-minute meeting with your team and make a decision. And the adjustment has been made, the pricing, the cost of it has been accounted for, and you're done. When you're not integrated in that respect, you've got to reach out to the architect, you've got to talk to the contractor. It takes weeks, lots of back and forth, lots of emails, lots of cost involved. When you're integrated in that way, you can really kind of zoom in on something, be quick, efficient, and keep the momentum going that you're looking to build.
Anthony, I think you got a solid case for your boutique, your company, your firm, how you've built it over the years. Mortar Group, really specializing in New York City, done doing some great things, been involved in some big projects. So I just want to thank you again for being on the podcast and introducing yourselves to our investors, our community of investors, and what you have to offer. So just thank you for your time and really appreciate it.
No, thank you. I appreciate it. This was great. Thank you so much.
Absolutely. Have a great day.
You too. Take care.
New York City real estate is not for the faint of heart. Anthony possesses a unique position as the principal of a small firm that does everything from real estate and architecture to construction and cost analysis. Be sure to check out the latest offerings on the Mortar Group website, where investors can invest right now in neighborhoods like Astoria, Williamsburg, and Prospect Heights. A big thanks to Anthony for coming on the podcast, and as always, a big thanks to you for listening. If you enjoyed today's episode, please leave a review or follow us on the streaming platform of your choice. Until the next time, take care.